We'd like to thank this week's podcast sponsor, Coinbase, a leading online cryptocurrency platform for buying, selling, trading, storing, and staking cryptocurrency. Coinbase is the only major publicly traded crypto exchange in the US, and it's used by millions of users in the UK alone. With a wide selection of more than 250 cryptocurrencies, industry-leading security measures, and a seamless user experience, Coinbase makes it easier to explore the world of crypto, whether you're just getting started or looking to expand your portfolio. To start your crypto journey, sign up through the link in the podcast description. But remember, don't invest unless you're prepared to lose all the money you invest. It is a high-risk investment, and you shouldn't expect to be protected if something goes wrong. Hello and welcome to episode 505 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. I'm excited. It's funny because I'm talking about an event that is yet to happen as we make this podcast, but by the time people listen to this show at the weekend, the event I'm talking about has actually occurred about 4 days earlier. So I mentioned last week I'm going to the Europa League final. Hopefully Spurs win. Knowing their past history, they probably won't. So we're recording the podcast the earliest maybe in a week we've ever done it. We're recording it on a Monday and it doesn't go out till the following Sunday. So that is probably a good habit for us to try and get into in the future. Anyway, Andy, it gives you a whole week to edit and make it look as good as it normally does, but possibly even better. So maybe we'll turn over a new leaf going forward, that we'll try and record the podcast earlier in the week.
No pressure there, saying that it's going to end up better than it usually does, especially as you're not going to be around for me to be able to feed back with. No, I'm super excited for you. It's going to be an interesting week if you come back and Spurs have lost, but I'm keeping everything crossed for you.
As an old friend, Andy, I had no doubt that you'd be crossing everything for Tottenham to win, but we shall see. But anyway, we're going to get on with what's on this week's show. So this week we're going to do usual 3 pieces, but the first piece I'm going to be doing is in relation to pension transfers, and it's a bit of a whistle-stop overview of pension transfers and why you would do it, why you might not, how long they should take. There's been a very interesting piece of research that's come out into how long pension transfers are taking. So there are rules around how long they should take, but the actual evidence has been published on how long certain providers are taking. So there is a naughty list of people who are taking longer than others. There is good news because I fear that lots of people don't transfer their pension, think it's going to take way longer than it does. We are now down to about 2 weeks, which I think the best pension providers transfer pensions across in, but more on that later in the show. The second piece I'm going to do is dispel 10 credit myths. So this was inspired by my trip to the Renaissance Foundation last week, where I was teaching young people about credit, and it came to light there's lots of things that people believe about credit that aren't true. So I want to go through some myths, and there'll probably be 1 or 2 that most listeners aren't aware of that they thought were true, but they are in fact myths. And the final piece on the podcast, Andy, you're going to be looking at.
Well, I'm going to be highlighting a particular type of fraud that has seen a 1,000% increase over the last year or so. It's quite terrifying in its simplicity, and I'll be explaining what that is later on in the show, how it works, how you can avoid becoming a victim. I'll give you a little spoiler. I don't want to give too much away, but if you've got a mobile phone, you potentially could become a victim.
So moving on to the first piece of the podcast. So I'm going to be looking at pension transfers, when it might make sense to move your pension savings to a new provider. What are the potential pitfalls? So the cons, we're going to look at the pros. We're also going to look at offers that are available to people who do move their money from one pension provider to another. And we're also going to look at how long it takes and how to minimize the time that you are out of the market if you do decide to transfer your pension. So starting with the pros of transferring a pension. So there can be some significant advantages. We'll come to the downsides a bit later. So one of them will be the potentially lower cost that you might get if you do move your pension, particularly from an old provider. Some old pension providers, and we're talking about defined contribution pensions throughout this piece. Some of the older pension providers do have high charges that will eat into your pension pot. So if you are able to move your pension to a new pension, it may mean that you can enjoy lower costs, which will help your pension grow more effectively going forward. Also, there is the possibility of consolidating multiple pensions. So we're not just talking about moving one defined contribution pension to another provider. You could potentially consolidate multiple defined contribution pensions to one place, which will have the benefit of meaning that you can manage them more easily, but it also means that you can have a consistent investment process across your whole pension pot, but also minimize costs as well. It does mean that you could potentially have a wider investment choice. So if you had an old pension, had a very limited investment choice, you could move to a new provider that has a broader range of funds that might better suit your risk appetite and your financial goals. There is also the pro of the improved flexibility that some newer schemes do provide. So some old schemes might not provide you with things like access to flexi access drawdown, for example. So when you want to access your pension benefits, older pensions may not give you the full suite of options. So by moving to a new pension provider, it means that you could have access to tools and also online access to your pension as well. So you may even be able to run it via an app, for example, rather than a very old pension where you are still doing things via paper statements. And also there is now the option to access transfer offers. So pension transfer offers are a relatively new thing. We've only seen them in the last few years, and on the Money to Masses website, as you can see on screen, we provide a roundup of the very best pension transfer offers. Now some of these are occasionally exclusive to Money to the Masses, so we're going to put a link to this particular article on the Money to the Masses website because we update it regularly as the offers change, so you can read it at your own leisure and see the latest offers. I'll scroll down them here, but typically there are offers that could give you a couple of £1,000 in cashback or even reduced charges. So of course there are cons to transferring a pension. So for example, the big one is the loss of valuable benefits. Older pensions, particularly defined benefit or final salary pensions, or those with guaranteed annuity rates, so they're sometimes called GARS as an acronym, can have extremely valuable benefits that would be lost on transfer. So these guarantees can provide a secure income for life and are rarely matched by modern defined contribution schemes. Now, fortunately, transferring a defined benefit pension worth over £30,000 legally requires you to take financial advice. And as a rule of thumb, a defined benefit scheme is best left where it is, so not transferring it across to a defined contribution scheme, and that is something that's reiterated by the FCA, the Financial Conduct Authority. But assuming that we are just still talking about defined contribution pensions, then one thing to watch out for is exit fees. Now, your current provider might charge an exit fee for you to transfer your pension pot elsewhere. Now, there is something to bear in mind though, because rules have changed in recent years. So exit fees are capped at 1% of the value of your pension for those aged over 55, which will be age 57 from 2028, as they are the earliest ages at which you can access your pension. Providers are banned from increasing the exit fees on policies where the exit fee is already less than 1%, and a complete ban on charging exit fees on pensions set up on or after the 31st of March 2017 was put in place. So it is something to be mindful of. You are unlikely to come across an exit fee, but it is possible. So always check your existing pension before you do anything to see if there are any exit fees that will be applied. And interestingly, some new providers, so if you are looking to move your money elsewhere, the new provider sometimes offers a deal where they may cover some or all of those exit fees when you transfer, but it isn't typical for providers to do that. Another big disadvantage is, of course, the market movement risk. So if you transfer your money as cash across to a new provider, it means that you are out of the market while you transfer your money and before you put it back into funds or investments of your choice. And so that can take several weeks, which means that you are out of the market and the market could move against you. So it could, for example, rise sharply while you're sitting in cash. Of course, on the flip side, it could move in your favor and the market could fall while you're sitting in cash, and therefore you are better off because you haven't lost anything by the time you are able to invest your money once it's gone across to the new provider. I mean, there is an alternative. You can conduct something called an in-specie transfer where your money remains invested while the transfer takes place, but I'm going to come back to that a little later on, especially as in-specie transfers are not as prevalent as perhaps we'd like them to be. Now, how long does a pension transfer take? One of the common frustrations with pension transfers, they take time, and PensionBee, who are probably the market leading pension consolidator out there, have provided some excellent insights in a recent report into pension transfers. The report highlights the disparity in the efficiency and speed of pension transfer processes across a whole range of providers. So, for example, you have Nutmeg, which has an average switch time of just 4.8 days. Now that is less than what you would have if you were switching current accounts under the current account switching service. So Nutmeg is leading the way with 4.8 days. Aviva is close behind at 5.1 days. Others like Fidelity take 7 days, Reassure 7.1 days, and Hargreaves Lansdown, who are the biggest platform in the UK, take just 8.7 days. But then we move down the list and there's a group of providers who take typically between 10 to 20 days to make a transfer according to PensionBee's research. So that includes the likes of Legal & General at 10.2 days, Scottish Widows at 10.5 days, Prudential at 11.7 days, and then you've got Nest Pensions, so that's the main pension that a lot of people will use via auto enrolment. They take 15.6 days, and Wesleyan take 18.8 days. However, the data also highlights a call for change for some providers, those taking between 20 and 30 days on average. This is looking back at 2024. That includes Willis Towers Watson at 20.6 days, Vanguard at 22.6 days, are taking a very long time to transfer people's pensions. The People's Partnership, that takes 23.6 days, and Scottish Friendly take a staggering 26.1 days. But there are pension providers who are even worse, and these are the people that PensionBee term the worst offenders, and they take routinely over a month to make a transfer. So this includes the likes of Mercer at 34.7 days, Capita at 37.2 days, and Virgin at 41.3 days. The very slowest end of the scale, you have RPMI at 56.9 days, and some local government pension schemes are averaging 59.4 days. So the positive is that there are plenty of providers who take less than 10 days to transfer your money, but there are some that will take over 50. PensionBee concludes that the potential reasons behind some of the lengthiest delays could be overly restrictive interpretation of regulations or a simple lack of investment in customer-focused processes. I also want to point out that there are legal limits on how long a pension transfer should take, and that is 6 months. So that's the legal limit. And if your pension provider is likely to fail to meet that 6-month deadline, then they need to tell you why and give you valid reasons for the delay. So if you do make a pension transfer and it doesn't go according to planning, of course you should make a complaint to your pension provider. And if you're unhappy with the outcome of that complaint, then ultimately you can take it to the Financial Ombudsman Service, FOS. So assuming you've weighed up the pros and cons and you're considering transferring your pension, so how do you go about it? Well, the first thing you should do is gather your pension details. So you'll need the name of your current pension provider, your policy number. A recent pension statement is the best place to find these. Then you need to choose your new provider, so you'll need to carry out some research. We have lots of reviews on the Main to Masses website where you can look at the best pensions in the UK. I'll put a link to that article in the notes of this particular video. Consider the fees, the investment options, and any transfer offers out there. Don't let the transfer offer drive your decision. If you want to move somewhere and they've got a transfer offer, then that's great, but don't let the offer be the overriding reason why you move your pension from one place to another, because the delays that occur could theoretically offset any benefit of a pension offer that you receive. Then when you've chosen your new pension provider, you need to contact them. They will have an online process or form normally to complete, and then they will contact your old pension provider on your behalf and arrange the transfer. You will inevitably have to complete some form of paperwork, which will mean you'll have to provide details of your existing pension and authorize the transfer. And then when you've done all that, you wait for the transfer to complete, and your new provider should should keep you updated on the progress. A couple of important points to finish on. You should consider taking financial advice, even if it's not legally required. So if it's not a defined benefit scheme or it's not a defined contribution scheme with guaranteed benefits that you are moving, if you're unsure about any aspect of the transfer, if you have complex circumstances, or if the amounts involved are significant, it's always wise to consider speaking to a qualified financial advisor, and they can help you assess if the transfer is right for your specific situation and help you navigate the whole process. Now, we put details in the notes below if you need help finding a suitable financial advisor that can help you. Also, beware of scams. Be extremely wary of unsolicited contact about pension transfers, promises of unusually high or guaranteed returns, or pressure to transfer quickly. Only deal with FCA regulated firms. And the final thing I want to really point out is about in-specie transfers. To mitigate the risk of being out of the market, some providers allow for what is known as an in-specie transfer. This is where your actual investments are transferred directly without being sold. This means you remain invested in the market throughout the whole transfer process. However, in-specie transfers are not always possible. If, for example, your new provider doesn't offer the same funds, and it can sometimes take longer than cash transfers, it's worth asking if this option is available if you're concerned about moving and being out of the market. And being honest, the providers that most likely to offer in-specie transfers are the very largest pension providers that give you access to all types of investment options like unit trusts, investment trusts, ETFs, and shares. If you're using one of the robo-advisors, you're going to be moving from one portfolio to a portfolio that only that provider has, so you won't be able to have an in-specie transfer. But even with the largest providers, if you move your pension pot across, it is often likely that only a portion of it will be allowed to be moved in specie because they have the same equivalent investment on the new platform, and therefore the rest will still go across as cash and you could still be out of the market. So that's a roundup of pension transfers. It can be beneficial for you to move your pension, but it is going to be dependent on your own individual circumstances. Always seek advice if you are unsure. And in the notes of this show, we've put links to a series of articles all about pension transfers that gives you full information about the pros and cons and things you should be thinking about.
Okay, so let's move on to the next piece of the podcast then, Damien. You're going to debunk 10 of the most popular credit myths.
Yeah, these are the credit myths that I've heard the most, or when people ask me questions about credit, and I just want to debunk them. And some might seem obvious to some listeners who've been following the show for a long time, but here are my top 10 common credit myths debunked. So number 1, checking my credit score will hurt it. Now, regularly checking your own credit report through people like Experian, Equifax or TransUnion uses soft searches, and it won't have any impact whatsoever on your credit report. So when you apply for credit, it's not going to be detrimental. The second myth is closing unused credit card accounts will boost your credit score. Actually, closing old accounts can reduce your overall available credit and increase your credit utilization. So that's the percentage of your available credit that you use. And you should always aim to have that around 30% or below. So if you reduce the amount of credit you have available, you could increase your credit utilization up through that, which will be negative when lenders assess you for a potential loan, for example, or a mortgage. But it also shortens your credit history potentially. So if you close an old credit card that you've had for a very long time, then that reduces the longest time that you've had credit, which is detrimental to your credit report and any assessment that they make, and therefore potentially lowers any scoring. Myth 3 is living with someone with a bad credit score will automatically drag you down. Now, generally that's not true at all, but the only way that it will be true is if you have joint financial products with them. So if you have something like a joint account or you have loans, then your credit files will be linked, they'll be associated. So be mindful of joint finances, and if you've ever had joint finances with somebody you no longer are with, then make sure you financially disassociate with them. So check your credit report, make sure there's no associations on there. If there are, then make sure you contact the credit rating agencies and disassociate with that person. Myth 4 is missing one or two small bill payments won't really hurt my credit report. Well, it will actually. All of them matter. It's because consistent on-time payments show reliability. Even missed utility or mobile phone bills can be reported, so every payment matters. Number 5 is paying off a defaulted account completely will erase the negative impact on your credit report. Now, that's not strictly true. Paying it off is good, but the default is usually recorded for up to 6 years in the UK. Myth 6, having no debt means that you have a perfect credit score. Lenders actually need to see how you manage credit, so building a positive history, even with a small credit card, is beneficial. Theoretically, having no credit history at all can be detrimental. Myth 7, there's a single magic credit score number to aim for. In reality, each credit agency will have its own scoring system, so Equifax, Experian and TransUnion. But even then, when you apply for credit, the lender will look at the information on your application and your credit report at one of the 3 credit rating agencies that I've just mentioned and calculate its own score to assess whether to lend to you. So you need to focus on building a positive credit history overall. Check your reports regularly, and even those numbers you see at those individual credit rating agencies are only really a guide. Myth 8, contacting a debt help charity like Step Change will hurt your credit report or score. That's completely false. And in fact, the FCA recently reported that of the 1.7 million people who had contacted a debt charity or service for help with their debts in the last year, 61% of them said that their debt was more manageable afterwards. So contacting a debt charity is something you should do if you are struggling with debt. Myth 9, when I die, my family will automatically be responsible for my debt. Now, generally, this isn't true because when a person passes away, their individual debts are typically paid from their estate. So the assets and money that they leave behind, they look at that and they look at the debt and then they pay them off from what's in the estate. If the estate isn't large enough to cover all the debts, the remaining debts are usually written off. Family members are generally not personally liable for a deceased relative's individual debts unless they were jointly held. So if you had something like a joint loan or mortgage, or they somehow co-signed for a debt, then yes, you could be liable for that debt. Myth 10, there's a credit blacklist that prevents certain people from ever getting credit. There is no such blacklist that exists industry-wide. If you're refused credit, it's based upon a specific lender's assessment of your credit worthiness according to their own lending criteria, and from the information that they've used on your credit report and application, that's what's led them to make a decision of not lending to you. So while a poor credit history can make it difficult to get approved for credit or secure favourable terms, it doesn't mean you're on a universal list that permanently bars you from all credit. Different lenders have different risk appetites, and don't forget, when it comes to certain negative markers being on your credit reports, they usually drop off after 6 years. So there you go, Andy. 10 credit myths debunked. Now, moving on to the final piece of this show, you mentioned about a new worrying scam that's starting to become more prevalent.
Yeah, so it's something called SIM swap fraud, and it's quite terrifying, really, in terms of how simple it is. So just to explain what it is, it's where a scammer will hijack your phone number, and they do this by convincing your mobile phone provider to transfer over a new number to a new SIM card, and then they control that SIM card. And once they have your number, they then effectively can control your calls and, crucially, your text messages. Now, the reason I'm highlighting this on the podcast and why it's so dangerous is just think about how important that is if someone is able to access your phone calls and also your text messages. Many of us rely on two-factor authentication, where a one-time code is sent to your mobile phone, often by SMS or text message, to verify your identity. And obviously, if a scammer has got access to those messages, they can access things like your bank account. They can then transfer money potentially. They can transfer passwords across to different accounts and change them on other online accounts, effectively locking you out of your email, which is a really scary thing, because if we think about what we deal with through our personal email accounts, it pretty much has access to all of our other passwords as well. They can also gain access to things like social media, and that's quite scary because then they can purport to be you and they can scam money out of your friends and family in that way too. And also with access to all of this information, they can of course open up new lines of credit and loans and things like that. So you can see the consequences of all this can be really devastating. And in fact, recent reports from CFAS, the UK's fraud protection service, shows that in 2024 there were over 3,000 cases of this unauthorized SIM swaps affecting mobile phone providers. So how can you protect yourself against this? Well, there's no single foolproof method. You can obviously do things though that make it much harder for scammers to gain access. So the first thing that we're going to say is guard your personal information. Be very careful about what you share online, especially on social media, because you might only be sharing small nuggets of information, but if someone is keeping tabs of what you share and where, they can start to use that like a bit of a puzzle and piece together different aspects of your life, whether it's, passwords and crucial bits of information, to then build up a profile on you to ultimately then speak to your mobile phone provider and do this SIM swap. So do be really careful about what you share online. You need to strengthen your mobile account security. So contact your mobile phone provider and ask about adding extra security to your account. And this could include things like setting up a unique PIN or a password. And then that password must be used for making changes like a SIM swap, for example. Also, another really good point, and something that I do, is use authentication apps, things like Google Authenticator. So rather than sending a one-time password or passcode to your text message, it will do it via the app and then it randomizes that number, making it much more secure. Another thing to consider is your general password security. Have a little think. Are you using the same password? Are you using weak passwords across various different places? Try and make sure that you use a different password for everywhere where you log in and try and keep tabs of those in a secure way. You might also want to consider using a password manager. There's lots of different services online. One of the best ones that you can get is Google itself has its own password manager, which you can create a very, very strong password, and it will also suggest strong passwords for you and save those within the app. So it's very, very secure. Just to finish this off, I'm going to give you some warning signs to look out for if you're worried about SIM swap fraud. So the first one is any loss of service. So if your phone suddenly loses signal for an extended period where it would normally work, contact your phone provider immediately. Maybe using another phone or method, because if you're worried about your phone has been potentially targeted, make sure you do that. Keep an eye out for any suspicious notifications. So if you receive any alerts about your SIM being activated on maybe another device, or requests for certain passwords that you didn't initiate, that is another warning sign. Get in touch with your phone provider. And any other general account unusual activity. So regularly check your bank accounts, regularly check all of your online accounts and your email. If you're starting to see some unusual activity come through via your emails or any other places like your bank account or credit cards, then that could be a warning sign that you have been victim of SIM swap fraud. Finally, just to finish off this piece, what do you do if you suspect you have become a victim? Well, contact your mobile phone provider immediately. Again, maybe not through your own phone. You can contact your phone provider via other people's phones that are on the same network, or there is a number online that you can contact. Explain that you suspect that you may have become a victim. They'll then investigate it and try and regain and control your phone number from their end. Do notify your bank account at the same time. Alert them to the potential fraud and what you specifically think has happened, because they do know about SIM swap fraud and there's certain things that they can do to initiate at their end, again, to stop text messages going to that phone. And finally, change any passwords if you can. Immediately change them on certain critical accounts, starting with your email and banking, obviously. And just finally, make sure that you do report it to Action Fraud. So there we go, Damien. Don't assume it won't happen to you. There's some warning signs to look out for there and some things you can do if you think you've become a victim. Do make sure that you take a few minutes to review your security on your phone. In fact, I'm going to be doing that straight after this podcast.
I think that's a brilliant piece for the podcast, Andy. It is frightening, as you say, because some people are just getting their details hacked from databases. It is also very topical because some newspapers have reported the fact that it's possible that this very type of fraud was integral in allowing hackers to gain access to Marks and Spencer's systems, as you've seen in the press recently and all the problems that they are having. On the note of passwords, if your software doesn't suggest a strong password for you, always remember that one of the best ways to make a strong password is to use 3 words. So if you ever heard of what 3 words, it's a very simple system. They use 3 random English words, and that creates a global map that shows you how many combinations there are, that every 3 meter squared position on the globe has been given a unique 3-word sequence that describes it. So that shows you the sheer size of the permutations of that. So if you just pick 3 random English words and put them together as a password, that would be incredibly secure, as long as they're not obviously all connected. So Andy, I think that's another great show on the podcast as ever. Do follow us on all our socials. We put lots of stuff out on socials that doesn't appear on the podcast, including deals on our Instagram page. I did actually use one of those deals to go to the cinema this weekend for just £4 with my family. So make sure you follow us on Instagram. You'll see our daily deals posted there. It's also in our weekly newsletter, which you can find at moneytothemessage.com/weekly-newsletter. There is a newsletter out at 10 o'clock every Sunday with all the important stories that impact your finances. As I say, follow us on all our socials, Instagram, TikTok, join our Facebook group, facebook.com/groups/money to the masses. And don't forget to subscribe to our YouTube channel. So all that's left for us to say, Andy, is come on, you Spurs.
I won't be saying that, but I will be saying until next time. And I do hope they win for an easy week next week. Until next time.
Until next time.